Bob, there have been some real concerns about the banking industry, which is surprising when you see a rising rate environment. You think that would be good for them, but we're talking about it this time in the context of also seeing a slowing economy, potentially concerns about recession. So what do you think as we get into the earnings? What should we be looking for? What do you think we'll see?
Becky, I think it's going to be a weak quarter for the big banks, pretty much across the piece. I think lending, both consumer lending and certainly the mortgage books, are much slower than they have been in previous quarters. I think fees for advisory businesses are going to be down significantly. We see that. I don't think it's a crisis. I think it's very much a reflection of what's going on in the economy and what's going on with the Fed right now. On the other hand, I think I'm kind of looking for which banks really surprise or please us with the trading operation. So I look at a Goldman Sachs, for example, in currencies and fixed income and equity secondary trading and commodities. How strong a performance will they have, which kind of sets them apart a little bit from just all of the other banks. I think in the UK, Barclays, as you mentioned, with the volatility in the UK, with the new leadership in the Conservative Party, with the announcements that the Chancellor had made, the currency trading in that market, gilt trading in that market with the intervention of the Bank of England in buying gilts, I think their trading operation should be pleasing as well. So I think there's some positive things about higher rates and higher volatility, but that's mostly around the trading books. I think it'll be, I guess the one other thing, Becky, I'd look at is change in provisions to see how the credit outlook for corporate U.S. is shaking out.
If we see big provisions, is that a reason to be concerned, or is that just an indication that the banks are being cautious and making sure that they are well provisioned?
I think it'll probably be both. I think the banks have steadily had better capital levels and are being more conservative in taking provisions for sure. But I would expect to see provisions reflect what's going on in the economy right now with higher interest rates. And for us, one of the sectors that we are pretty positive on is the high yield market. And I think, the positive is the high yield market is going to have some real opportunities. The negative is for lending institutions and lending banks, it's going to hit their provisions potentially pretty heavily.
That's the one thing. I mean, when banks start taking big provisions, you just wonder what they know that the rest of us don't. Is there a scenario where we look and say, uh-oh, there's way more under the surface here than we'd realized?
No, as I said, I don't think this is going to be a crisis period, so I don't expect, a crazy spike. But I think part of our bullishness on high yield is there are certain sectors, certain companies that, with 12, 13 years of zero interest rates and lower covenants, there's some good companies out there that have bad capital structures. And I think that's going to be an interesting investing opportunity. I don't think we'll see a debacle in provisions across the banks. I do think it will reflect what the Fed has been up to, the higher interest rates, and the economy starting to slow and get worse.